Good evening, everyone. On behalf of Edelweiss, let me welcome you to Redington Q4 FY18 earnings call. We have with us the management of Redington headed by Mr. Raj Shankar along with the other senior members of the management team. Without further ado, I'll hand over the call to Mr. Raj Shankar to start the proceedings. Thank you.
Thank you, Pranav. Thanks to everyone who has joined us on the call today. I'll quickly go over the results both for the quarter Q4 FY18 as well as the full year FY18. For the quarter, our revenue at a consolidated level grew by 5%. Our profits degrew by 6%. If for a moment you decompose the revenue between India and overseas, India degrew by 4%, while overseas grew by 10%. I hasten to add here that there was a translation loss on account of the rupee appreciation for the Q4 quarter, which was about 3.6%. So in other words, if we therefore add back this translation loss to the overseas growth of 10%, the actual growth should have been 13.6%. Likewise, in India, on account of the GST, there has been a revenue loss, some of which has already got explained in the earlier period. The impact on account of this GST on revenue was minus 6.1%. So in other words, if India degrowth for the quarter, which was 4%, we add back this revenue loss on account of GST of 6.1%, it would have actually resulted in a growth of 2%. Similarly, when you look at the profit after tax, and when you decompose that between India and overseas, India degrew by 27%, while overseas grew by 7%. And this 7% is after taking a translation loss of 3.6%. So in effect, the actual growth should have been 10.6%. Now, as we look at the overseas performance briefly, between what happened in Turkey, as all of you know, has been quite challenging for the whole year and more so in the last quarter. So if you look at the performance of the company of the overseas chapter without Turkey, the growth would have been 11% on revenue and 7% on profit after tax. Of course, this is after taking into account the translation loss of 3.6%. Now, when you look at the businesses, IT vertical grew by 5%, mobility degrew by 1%, and the services business grew by 45%, all of which at a consolidated level. Now, when you look at India in particular, IT business grew by 4%, and allow me once more to give you the growth rate after adjusting for the GST impact. So after adjusting for that, the growth in IT should have been 11.1%. Likewise, mobility degrew in India by 34% and services grew by 54%. Overseas, IT grew by 6%, mobility by 15%, and services grew by 30%, all of which is after the translation loss of 3.6%. From a working capital point of view for the quarter, at a consolidated level, we managed to contain it at 40 days, thereby having about 9 working capital turns. Overseas, once again, has managed to contain the working capital at 33 days, as against India, which is at 55 days. In India, the working capital increase was by 5 days, which is essentially on account of the debtor days having gone up. What we observed, particularly for the last quarter, is that the enterprise business, the credit period has become longer compared to what it used to be by at least three to 4 weeks. And this has resulted partly on account of the higher debtor days. Also on the mobility, there has been a delay in terms of payment to the extent of about 2 additional weeks compared to the normal. So in summary, the increase in working capital in India by 5 days in Q4 18 compared to Q4 17 is largely and mainly attributed to the debtor days having gone up. Whereas overseas, which was 32 days in Q4 17, is now for Q4 18 at 33 days, pretty much at the same level. From an operating cash flow point of view, we have a negative cash flow of 306 crores. The free cash flow is negative at 357 crores. This is essentially on account of the higher working capital, particularly in India. Also, I just want to mention that last year in Q4 of FY17, we had an exceptionally good working capital and performance by overseas, while the performance in overseas in this quarter came very close, but there is still, it was not good enough to generate positive free cash flow. Last but not the least, with regard to last quarter, our return on capital employed at a consolidated level was 17.6%, and our return on equity was 17%. Now I switch gears to our full year 2018. Our revenue at a consolidated level grew by 6%, and our profit after tax grew by 4%. And once again, if we disaggregate this between India and overseas, India degrew by 2%, whilst overseas grew by 11%. Here again, just one more time, if you adjust for GST, the India revenue growth would have been positive 2.5%. Likewise, if we adjust for the translation loss on account of the rupee appreciation, the overseas revenue growth, which was 11%, would have been 14.7%. From a profit after tax point of view, India degrew by 10% for the full year, while overseas grew by 16%. Now, as we look at the performance of overseas without Turkey, once again, just bringing in the factor that Turkey for the full year was extremely challenging. In fact, the effective tax rate, income tax rate, was 90%. So it was an extremely difficult period. As some of you would know, that the exchange rate, which was somewhere stabilizing at about 3.75 Turkish lira to a dollar, depreciated almost within a matter of few weeks to as much as 4.5 Turkish lira to a dollar, and this had a telling effect on the performance. So without Turkey for a moment, the overseas revenue growth for the full year would have been 13%, and the profit after tax would have been 20%. However, with Turkey, it is 11 and 16% respectively. Now, when we look at by business, IT distribution business at a consolidated level grew by 3%. Mobility business grew by 8%, and services business grew by 23%. Now, when you look at India in particular, the IT business grew by 1%, which in reality, after adjusting for GST, would have been about 6.4%. Mobility degrew by 16%, and after adjusting for GST, it would have been a negative growth of 14%, and services grew by 30%, and after adjusting for GST, would have grown by 31.5%. Overseas, the IT business grew by 4%, the mobility grew by 21%, and the services business grew by 13%, all of which is after a translation loss of about 3.7%. Now, coming to the full year working capital, the working capital at a consolidated level increased by 2 days from 41 in FY17 to 43 days in FY18. Overseas managed to pretty much operate at the same level, which is 34 for last year to 35 days in FY18. In India, the working capital went up by 4 days from 53 in FY17 to 57 days in FY18. Here again, the main reason for this increase is attributed to the debtor days having gone up, and this, as I've already explained for the quarter, the same reason holds good, which is our enterprise business saw a much higher increase in the credit period. This was also true for our mobility business. For the full year, we delivered a positive operating cash flow of 184 crores, 124 of which came from India, and 60 crores was delivered by the overseas. From a free cash flow point of view, it was negative at a consolidated level of 94 crores, 42 from India and 52 from overseas. The debt equity position has been quite good and strong. So the net debt was 0.24 at a consolidated level for the full year, as against 0.23 for FY17. Overseas was 0.09. India was 0.57. From a return on capital employed for the full year, the consolidated position was 15.5% and the return on equity was 14.5%. I also want to share with you the results, particularly on ProConnect. For the quarter, our revenue growth was 59% and our profit growth after tax was 33%. For the full year, ProConnect grew by 74% on revenue and 33% on the profit after tax. As far as Ensure business is concerned, for the full year, the revenue degrew by 2% and the profit degrew by 10%. Though for the quarter, the revenue grew by 15% and the profit after tax degrew by 16%. This pretty much sums up for our quarter Q4 and the full year results. I also want to briefly touch upon how we see the outlook for FY19. We believe that we are going through a difficult period overall as far as the economy is concerned. And for instance, the interest rates have started to really increase both in India as well as in the overseas. There has been quite a conspicuous increase already. We are also seeing that the rupee has started to seriously depreciate. I already touched upon what happened in Turkey, particularly in the last 1 month. So given all of this, we believe that while FY19, the company will grow both revenue and profit better than what we did in FY18, but H1 may tend to be a little slower in terms of the growth, but we certainly see a strong rebound in H2. I will pause at this stage and turn it over back to Pranav and to all of you in case you have any questions.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1. The first question is from the line of Nitin Padmanabhan from Investec. Please go ahead.
Hey, hi Raj. Thanks for the opportunity. Just wanted to understand your thoughts on what specifically is happening in the India business. What's driving the increased credit period? Is it higher competitive intensity or the slowness in growth? Typically, we have seen, improvement in growth followed by increase in interest rates. But this time around, we're actually seeing slow growth and interest rates moving up. So does that mean that for us, our PBT margins could be lower next year? So that's the first part of the question, actually.
So, hi, Nitin. So to take your first question first, See, one of the reasons why we are seeing the increase in debtor days is essentially on the enterprise, where some of these larger projects, whether it is smart city or some of the larger projects, comes with a longer credit period than in the past. So it takes time for some of these projects to be rolled out, and generally there is an expectation that this would get supported by an additional 30 days of credit than the usual. It is not so much to do with our ability to make money. It's to do with the fact that these transactions typically require a longer gestation period to implement the IT solution, and therefore everyone is trying to see to the extent possible to request for a longer credit period. If we do not accept these additional credit period, then sometimes we lose the opportunity itself. Therefore, we have been selective in which opportunities to engage, and we do oblige because we want to definitely participate in these transactions. To your other question about the interest rate and the link to the profit, etc., we are not seeing any contraction as far as our margin is concerned. If at all, there has been purely an aberration that has happened in one business, more because the market operating price on account of the frequent change in the basic customs duty had an impact. Barring that, which was more an aberration, we are not seeing any contraction to the margin. To the point very specifically about the interest rate going up, as you would know, in our business, we tend to factor this interest as a part of the pricing itself. So wherever we are taking any new deals or engaging in new opportunities, we make sure that the interest rate is passed on, and we always buffer a little more than what the reality is. But on a side note, as you very well know, Redington has, for instance, if you take the whole of last year, our weighted average cost of debt capital was less than 7%. And therefore, even though the interest rates would rise, we would certainly have a much more competitive interest rates because we look at various other instruments while raising capital. So I can only give you this comfort that yes, interest rates will firm up. We have the ability, especially in deals and in large projects, to be able to factor this interest rate. So this will not have any detrimental impact to the margin and hence to the profit.
Sure, that was helpful. Just one thing, if I might cross-check, is you mentioned the smart city projects and extended credit days. But the entire the part of the question is, what is the credit days for those businesses that we are looking at nowadays? And the second is, overall there has been a weakness. So smart city alone is not the only source of weakness. What else is driving the weakness in the overall spend?
So let me paraphrase it differently. As I had mentioned to you, the IT business has grown both in India and outside India. And I also want to clarify that we have grown both our value-added distribution business as well as our volume business. So the business that actually degrew was the mobility business, which is the point I was trying to make. So imagine a situation where the basic customs duty for smartphones was increased from 0 to 10% in July of last year, became 10 to 15% in December of last year, and became 15 to 20% in February of last year. So what really happened is, at a given point in time, all the distributors were saddled with inventories with different customs duty. So this led to a complete mayhem in the market where there was different market operating price, and therefore we decided consciously to slow down our business, but then no matter what, we had to inevitably go with the flow, and when therefore customers paid late during this period, we had to accept it, and because the market operating prices had crashed, we also had to go with it. So this led to a sort of impact on account of the mobility business degrowing, and hence the overall business, degrowing marginally. But for this, every other business, whether it is the IT, value or volume, whether it is the services, did show growth.
Sure, thank you so much. I'll come for a follow-up.
Thank you. The next question is from the line of Madhu Babu from Prabhudas Lilladher. Please go ahead.
So the weakness in India mobility, is it mainly to do with the iPhone traction remaining weak, both for iPhone 8 and iPhone X?
So basically, as I mentioned to you, the biggest challenge that we had is this last quarter was an aberration. Imagine at a given point in time, you have three stocks in the market, one with 10%, one with 15%, and one 20%. So depending upon who was carrying how much inventory of which particular customs duty, they had an unfair advantage or whatever, and the others had to follow suit. So this completely led to a mayhem situation in January, February, March. My request to you is not to overread too much into what happened last quarter. We, in fact, are reasonably confident. We are starting to see some corrections happen in the marketplace already. While this quarter we are seeing the fag end of it, going forward from 1st July, you would see this is something that should not play out.
So we are saying that 1H will be relatively soft. So is it to do with the mobility remaining weak, or even IT you're seeing some patches of softness?
Sorry?
We have said that 1H will be softer in FY19. So my question is also whether because that is you're seeing softness in the mobility portfolio or even IT. I mean, the reason behind the cautious commentary for 1H. The first half of FY19, yeah.
Sorry, I didn't pick up on that 1H. Okay, good. So the reason I was just being a little cautious on H1 is particularly for the current quarter, some of these things do take time to play out. Take, for instance, the GST impact. Just as an example. So that continues to be a challenge even in this quarter. Hopefully, from next quarter, which is July, August, September, some of this should correct itself or should get normalized. So therefore, at the moment, one wants to be cautious on that score. Likewise, when you look at our own, this enterprise business I spoke about, while we are growing, the fact remains that there is a longer credit period. It is impacting our working capital. So we are trying to balance it, and this year, particularly in India, we want to make sure that we manage our working capital better. So to that extent, we may want to compromise a little bit on growth in order to get the hygiene in place. So the whole idea was that we want to make sure that in Q1, we should be able to correct ourselves so that as we look at Q2 and beyond, things should start to look much better.
Sir, and this 1450 crore of debt, could you give the breakup? I mean, the Indian debt, what is the cost of debt, and the foreign debt? Just to have more clarity on the cost structure of this debt.
Okay. So, as I mentioned to you, in India, it was a little shy of 7%. As far as outside India is concerned, it's about 5%.
Outside India is linked to LIBOR?
It is linked to LIBOR, but in certain markets like Turkey, we also borrow in Turkish lira, so where the interest rate is about 15 to 16%. So, of course, we have a blend between both. So, the weighted average cost of debt capital for our overseas business is about 5%.
Okay. Sir, and just one last question. Turkey, this issue keeps coming up every 1.5 to 2 years. So I understand it's a sizable presence you have there, but can we look at, selling that part of business, or because every time, because there is no hedge for that currency and we keep getting this risk again and again?
Now, just to share with you, the contribution from a revenue standpoint of Turkey is approximately about 7 to 8%. The contribution from a profit standpoint is approximately about 3%. So, honestly, it does not have a serious material impact to the overall revenue and the profits of the company. So, if you remember, I had mentioned to you, if for a moment we take it as without Turkey, our growth would have been 13% on revenue. With Turkey, for the full year, it was 11%. As far as profit is concerned, it was 20% and 16%. So I really don't want you to worry too much about this point. We have very clear plans on how we want to address this, but we also have to take into consideration that there is now a presidential election which was slated for 2019, which has now been preponed to June 24 of 2018. So this quarter, let that play out. We are hoping then for 5 years, once it comes under whoever be the president, for the next 5 years at least, there is not going to be any more of these elections, etc., which can slow down this economy.
Okay, sir. Thanks.
Thank you. The next question is from the line of Vishal Desai from Axis Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. Raj Shankar, I just wanted to understand a couple of things, both on the India and the overseas space. While I understand that H1 is likely to be soft, what gives you the confidence that H2 would pick up, and more so, where do you see growth being driven by? Would you expect the enterprise momentum to revive in the India piece? Because I remember categorically in the last call you had mentioned that there are some green shoots emerging on the PSU side, and some amount of correction, if I may, is likely to even happen on the mobility piece, where Apple didn't see the kind of momentum which everyone was expecting. While we read reports that iPhone 10 to be precise, and probably 8 is doing pretty well globally in the recent past, would you be able to give us some color as to how you are seeing it?
Right. So, just before I get to FY19 and H1 and H2 and so on, I just wanted to share some statistical information on the quarter gone by. In India, the number of PCs sold for last quarter grew by 4%, whereas Redington in India grew by 16%. Likewise, when you look at overseas, the PC market grew by 6%, Redington grew by 5%. So the first submission I want to make is, I repeat, IT business continues to be the core business, continues to see growth, though it may have got slowed down but we are still seeing growth both in India as well as outside India. So to your question, we continue to see growth in IT and particularly on the enterprise side of the business. We see growth also on consumer, though it is likely to be a single-digit growth. Likewise, the same is true for outside India as well, where we see growth opportunities both on the value-added distribution business as well as the volume business. As far as mobility is concerned, I would like to believe that our growth opportunity is very clearly there because in terms of our portfolio, we think that we will have a better portfolio in FY19 than we had before. Number two, the way FY18 panned out for us, I think it was some two very difficult quarters that we had. I expect that in FY19, even if we have had a normal quarter, we should be doing much better than what happened in FY18. So suffice it to say, IT in India, both value and volume, is clearly slated for a growth with a higher growth opportunity on the enterprise. As far as mobility is concerned, with our portfolio increase and very importantly with regard to how we expect even our current portfolio to play out will be much stronger and better in FY19 and more so in H2.
Sure. Thanks for that. Just if I can dig a little bit deeper, in terms of Apple, I had asked also that while we were expecting some amount of course correction to happen more so from the parent, that is Apple itself, have we seen any kind of, improvement in our volumes or what is your commentary in terms of what has happened in this quarter and what we are seeing going forward as well?
So as mentioned to you, if you keep the January, February, March more as an aberration, I can tell you there is certainly an improvement that we see in this quarter, but we are very hopeful of there are some changes that we think would happen. When some of those changes, take place, which we are hoping should happen in the near term, this should have a positive effect for us. Overall, I can only tell you our outlook as far as mobility business is concerned is positive as far as FY19, both from a top line and from a bottom line, very clearly.
Sure. Just one last bookkeeping question on the split of the margins, split of the business in terms of value versus volume on the IT side. Could you help us with that number, please?
Yeah. So approximately 56% is value, 44% is volume as far as India is concerned. Overseas, just 1 second, please. Overseas. Yeah, overseas is 31% on value and 69% on volume.
Okay, thanks for that. And sorry, just one more thing. With this whole interest rate scenario rising, I take cognizant of the fact that you guys also buffered that into your pricing with a little bit headroom as well. Is it fair to assume that margins could probably not see a big uptick or could be impacted more so due to these situations?
Okay, so about 70 to 80% of our business on the value-added space is typically deals, projects, and what we call as back-to-back deals, where we would be able to a large extent, factor the interest rate increase. But to the extent of 20-30%, which is more a stock and sell, is something that we would try and make up for it by uplifting the price, because we are able to make immediate availability of that product and offer an immediate solution to the customer. So in both instances, we should be able to cover a good part of this increase in the interest rate.
Sure. Thanks for that. Thanks, Rajshekhar and Krishnan. Have a good year ahead.
Thank you.
Thank you. The next question is from the line of Rabindra Nayak from Sunidhi Securities. Please go ahead.
Good evening, sir, and thank you for the opportunity. Sir, one question regarding this ProConnect, and what are the drivers available for growth in FY19? Because, if you understand, 18 was a good year due to the addition of the Rajpratim business. So what are the drivers you see for growth in the ProConnect in FY19? And due to this acquisition, the mergers of Flipkart with, this Walmart, what are the challenges and opportunities do we see in ProConnect?
Just to clarify, I do agree with you that we had a good positive effect on account of the inorganic opportunity. But even if for a minute you remove the Rajpratim, the revenue growth would have been 35%. So I just thought, while of course the growth of 74% comes on account of this acquisition, even without that it would have been a 35% growth. And to also clarify on the bottom line, the growth would have been 21%, which otherwise, including this acquisition, was 33%. So that we are able to, understand that even without this, there is a good, strong growth momentum as far as the ProConnect business is concerned. Now, what we have done, and quite successfully, is to continuously look at, different elements of logistics. What started off as a pure warehouse management services play, today the warehouse management service would probably contribute roughly to between 45 and 50%. So a good part coming out of transportation, out of value-added services. We've also gotten into some high premium services for certain niche products. So there are lots of interesting aspects that we have built and capabilities that we have built. This is on one hand. On the other, we have also built a good capacity. So imagine having about 6 million square feet of warehouse space, number of warehouses, about 165 warehouses on a pan-India basis. So I think we have also built a good, deep capacity. Plus, we have today addressing a number of industry verticals, and there are some which is showing a lot of traction. So it is not confined to just IT and telecom and e-commerce, but we are today addressing about 12 to 14 industry verticals, and there are some where we are expecting to see much higher traction going forward. While organically we think there is a high headroom for growth, we are also looking at how do we really do some strategic investments as far as ProConnect is concerned, which can help us to, not only accelerate our growth, but importantly help us to participate in different opportunities which today we are not fully participating. So the net and sum is, with or without the acquisition we made last year, ProConnect has grown by 35% and 21%, both on the top and bottom line. Two, we are now participating not just in the warehouse management services, slowly moving towards becoming an integrated logistics player. Instead of just focusing on IT and telecom and e-commerce, we are now moving rapidly into a number of other industry verticals. And last but not the least, we also have very clearly in our mind looking for certain strategic investments and opportunities which can help us to scale and accelerate the growth.
Okay. Regarding this Flipkart and Walmart, what are the challenges ProConnect would face or opportunities?
At the moment, we continue to be well engaged. We do not see, at least in the foreseeable future, we do not see any impact to our business. And plus, as I had mentioned to you, when we have about 120 customers, so we are very nicely spread out and there is no concentration risk with any one customer. Or with any one industry vertical. So all that I can tell you is today the ProConnect in this 5-6 years has really built a very nice business and it has built a lot of good strong feet, and you will see that this momentum of growth will continue.
Okay. Sir, any CapEx plan? What is the CapEx plan for ProConnect for this year?
Yeah. Overall, we think about 150 to 200 crores will be the CapEx, and we are also looking at another 150 crores for acquisition. So this will be over the next 3 to 4 year period.
Okay. So total is 300 crores. That target remains same that we have initiated in the last year, right?
Yeah.
Okay. Thank you.
Thank you. The next question is from the line of Hiten Jain from Invesco. Please go ahead.
Yeah, this GST implementation issue, so when this GST was introduced, we said that although we were ready, but a lot of our vendors were not ready with the systems, and we were expecting that the demand will come back in 1 or 2 quarters. Now it seems 3 quarters has passed, and still we are saying that the vendors are still having issues with GST. And I was just wondering, you told the impact was 6% growth. I mean, the 6% of the growth was lost due to GST. So, I mean, how should we look at it? After all, it is just a system change and taxation change. So, I mean, vendors need to adapt to that for their normal run of business. I mean, so how is it on ground? So, I mean, so much of time has passed and still we are expecting 2 more quarters. And how did we calculate this number? Is it that if you can just help me understand what are the challenges which we are till now we are facing, which are not getting ironed out?
Yeah, I'll let Krishnan answer that. Over to you, Krishnan.
Yeah. This, growth, lower growth because of GST, it is nothing to do with vendors' preparation. Basically, it's like this. In the erstwhile taxation structure, there were, if it's a local purchase, excise duty, if it's an import purchase, CVD, which would get built as part of our costing, and there is a margin that we add, and that becomes the sale. Now, this excise duty and CVD are all become GST, which is a creditable amount. So if earlier it was 100 plus 10, it is now 100. So to that extent, if you are adding another 5 rupees to the margin, it is 105 and not 115 in the erstwhile case. That difference is what we mentioned as 6.1%. So it is basically the change in the taxation structure between the pre-GST and post-GST period.
So is this a normal, accounting thing, or how it is?
Yeah, it is the way it is published in the financials. See, again, if I just need to refer to this example, assume the vendor wants to bill it to us at 100 rupees, and earlier the excise duty was 10, it was 110. And our buying price will be 110. We add 5 rupees. Our selling price will be 115, isn't it? And there is a margin of 5, and the margin of 5 rupees. Yeah. Now, he will be billing at 100. That 10 is now GST. Let us not get into the rate. That 10 is now part of GST. My cost is 100. My sales price is 105. That difference between 115 and 105 is the difference because of GST that we are talking about.
Okay, so is it that when you say first half will be weak because, I mean, all the parameters that we said, because Turkey is going through that elections and a small proportion of our total profits, the mobile portfolio is much better, and even PC sales, enterprise IT is giving double digits just because of this GST thing that it did not show up in the actual numbers. So it is that only first half, so that means perhaps the base needs to be reset due to this GST, and there is no demand disruption. There is no demand disruption which is driving your comment saying that first half will be soft. Is it that?
Yeah, I think you have understood it right.
Okay. All right. Thank you.
Thank you. The next question is from the line of Ashish Agarwal from Principal Mutual Fund. Please go ahead.
Yeah, thanks. Sir, actually, I have a question on the margins on the India side. With the GST, at least the reported margin should have been looked higher. And also with the growth more coming on the IT side rather than mobility, the margin should still have been higher. But we have not seen that in the India margins. What could be the reason for that?
Okay. See, again, the margin is a function of the product mix, where if there is a particular product line where we had multiple challenges, not only GST, that had an adverse impact in terms of the overall margin percentage. And second, by GST, margin percentage will improve. It may not be technically correct because margin is not a fixed amount. The margin is a function of the expectation in the marketplace that will automatically get aligned. So the drop in margins is because of the mix of products and some of the products not generating enough margin like before.
Okay. So how should we look at margins then going forward?
So our margin as far as the India business is concerned, please leave aside FY18 more because there were lots of challenges, whether it is on account of GST or many others. Okay. So please treat this outside. What we have delivered prior to that, which is FY17, is what you can take as a base, point number one. Point number two, as we now continue to scale our ProConnect business, as also some of our other services business, just to share with you, the overall services business used to contribute to about 3% of the India revenue and about 8% of the India profits. This year, that is in FY18, it contributes to more than 5% of the India revenue and contributing to close to 20% on the India profits. So I think it is important to keep in mind, therefore, over time, as we continue to scale the services business, it will have a positive impact on the profits.
Okay, sir. Thanks a lot.
Thank you. The next question is from the line of Rohit Dokania from IDFC Securities. Please go ahead.
Yeah, hi, good evening. I just had a quick question. Can you talk about the tax rate that one should build in for FY19 and 20?
Yeah, you can safely take about 24 to 25%.
Okay, that is helpful. Thanks a lot.
Thank you. Participants, to ask a question, please press star, then 1. The next question is from the line of Alik Dalal from 130 Capital. Please go ahead.
Yeah, hi. Could you give me the net income growth adjusted for this for GST and FX translation on a consolidated basis for this quarter?
Yeah. So this would have been for the quarter. Sorry, for the quarter, this would have been adjusted. You said both for GST and the translation loss, correct?
Yes, correct. Yeah.
Okay. So rough and ready, it will be about -2% on the profits. Sorry, on revenue you asked. I stand corrected.
No. Yeah, on PAT.
On PAT. Yeah. Okay, so that's -2%. And for the full year, the impact would have been approximately in the vicinity of about 7%.
Okay. And can you give some color on these new business initiatives that you had talked about in terms of solar and medical devices and what the progress is there?
So the first is with regard to both the health and medical equipment and solar. The business from a revenue growth Okay, so the business grew by almost about 70%, about 65 to 70% on the top line. But this is in spite of the fact that for a good 4 months, if not more, we were seriously impacted on account of this anti-dumping duty issue that came up for the panels. So during this period, the basic customs duty for solar panels were treated in par with the DC generators, and this had a serious impact where the containers were just not getting cleared at the port. And we went through a very, very difficult period where the business pretty much came to a grinding halt. So, however, this issue is now behind us. Finally, in April of this year, the issue has been resolved. So now we are good to go. So we are extremely positive with regard to the outlook for the solar business. As far as health and medical equipment is concerned, the progress has been good because we have signed up contracts with a number of global vendors, and it is starting to show traction. So we are on course as far as solar is concerned. As far as HME is concerned, we are a little bit behind our plan, but we hope that in the next 2-3 years we will make it out.
Okay. And just one last question. In terms of the underutilization of the balance sheet, how are you thinking about accelerating that? Is there any plans for buybacks or higher dividends or so on in the future, or any new business lines you wish to capitalize or acquisitions?
So you hit a very interesting point. During our board meeting today, we discussed various options. So give us a little time and we will get back to you, with some of the options that we are seriously evaluating, not just one, multiple options. All that I can tell you is while we are happy that our debt level is quite low and under control, you are right, there is an opportunity for us to leverage that. So wait for us to come back to you. Stay tuned.
Okay. Thank you.
Thank you. Ladies and gentlemen, as there are no further questions from the participants, I now hand the conference over to Mr. Pranav Kshatriya for closing comments.
Hi. Thank you very much for participating on the call. I'll hand over the call to Mr. Raj Shankar for his final remark. Thank you once again.
Thank you, Pranav. So just one more time, we had a very difficult quarter. We had a very difficult FY18. In spite of that, overall for the year, we grew top line by 6%, bottom line by 4%, and this is after taking a translation loss of 3.7% on the overseas. This is in spite of the GST impact, where there was a revenue loss of about 6.1%. The overseas did very well during this period, where the growth as far as overseas was concerned was 11 and 16% on the top and bottom line. The working capital on the overseas continued to be managed well. We have taken working capital management in India as a very clear mandate for the current year. We are more than hopeful that the FY19 numbers in terms of revenue and PAT would be much better than FY18, though we would be off to a slow start in H1 as was clarified. Our debt levels continue to be enviably low, and as mentioned towards the end of the call, we are contemplating various options on how do we deal with this. We have delivered operating cash flow at a consolidated level, though at a free cash flow it was negative 94 crores for the full year. Thanks to everyone who had participated on this call, and good day and goodbye.